We have with us a special guest, Mehul Mohanka, Managing Director and Group CEO of Tega Industries. Tega is in some ways a mid-cap company, which Neeraj and me were discussing that it is a hidden gem of sorts. It is an ancillary to the mining sector, but doesn't get impacted with the slowdown in the sector. To understand more about the company and get perspective on what Tega does, what the outlook looks like, and whether or not it should be a stock one could look at, we have with us Mehul. We have Mehul with us in the studios. Mehul, you know, your name doesn't give away too much. And if you, I think the starting point of this conversation is, because we've already done an earnings review, is simplify for our viewers what Tega Corp is. I do understand it's an ancillary to the mining business, but it doesn't get impacted by changes in the macros, from what I understand. You want to tell us a little bit about Tega, and then we go into, of course, discussing a lot more.
Yeah, first of all, thank you for having me here at the studio. What Tega does is what we call manufacturing and designing of products which are called critical to operate consumables in the mining space. For customers, we are an OPEX spend, so hence we are quite devoid from CapEx cycles in the commodity cycles. And all of Tega's products are installed in what we call a mineral process plant in a mine. And we aid in extraction of metal from the rock once it's excavated from the mine. So that's what our business is. We try and define it as all above ground operations. So we're not in the excavation of rock from the earth, but processing of the rock to extract metals from the rock.
So fair assumption that with everything that's happening in your sector or in the metals and mining and commodity space, you're rather insulated from it, because it really doesn't matter if commodity prices are moving up or down.
Yeah, absolutely. So the best way I kind of position our business is that if you want to, as an investor, ride the commodity cycle without the risks of the CapEx side of it, we are the best company in that spot, because we have an OPEX related business.
So you're an Indian company with Indian roots, but India is not the largest mining country in the world. You've got Latin America, you've got Africa. Explain this to me, right? So you're based here, but you're servicing, and I'm assuming you're servicing countries far out. How does that dynamic work, and where does the experience come from?
So in the truest sense, we're an Indian-born MNC. So we have manufacturing locations in South America, in Chile, in South Africa, Australia, and about 7 manufacturing plants in India. And the reason for that is we try and always be closest to our customers that we serve, because as I said, it's a critical to operate product, so customers have huge expenses and liabilities if there is downtime on the equipment. So it's imperative that we are close to them, and that's why we ensure that we are as close to the customer as possible when it comes to serving them. So our ethos is about 48 hours from a phone call, we would like to be at a customer's site. Now, in India, the mining industry has not been growing as rapidly as it has across the world. So in India, I think our contribution of mining is less than 2% of our GDP. And markets overseas, because of the size of the plants, tend to be way larger than we have in India. And hence, the demand for our products has always been and will be much higher outside of India. Hence, our revenue mix is such, and it reflects that 85% of our revenue is exported, is non-India centric.
These are very unstable economies and dangerous in some ways. Is that, relative to India, of course, Latin America, Africa, do you hedge yourself? And also this landscape is evolving, right? You'd imagine this competition coming in, you might have geographical biases. Is that a risk to the outlook of Tega for the next 2 to 3 years?
Well, one can always be faced with geopolitical risks. Mining countries or commodity-led countries tend to be a bit more riskier than the others. But then we have been in the business where we've been able to de-risk ourselves from a geography perspective. So today, as I said, we have manufacturing bases across the world. We ship to over 96 countries today globally. So that itself is a diversification of our portfolio from a risk perspective. Coupled with that, we have multiple product lines which serve customers across metals across the world. Geopolitical issues will always be there in our business, but we've been around for such a long time that we've been able to plan and circumvent them over our existence so far. So I think that's how we look at it.
Mehul, what about the fact that China seems to be slowing down at a much more rapid pace than what people would have thought at the start of the year? Does that have an impact on the mining ops of companies which might be owning some of these mines? Because if the end product prices are going down, if the fortunes, as they say, are changing, do they go slow on the OPEX as well, or not quite?
Yeah, so China is a big market for mining, but we've intentionally stayed away from China because I've always believed that China is a one-time supply market, and we have a lot of inherent IP in our product, which I would not want it exposed in an economy which we cannot protect our IP in. So we've always looked at growth for ourselves outside of China. And today there are Chinese companies who are operating in our space, but they're at a much, much lower value add segment. So they're in a segment which we've already exited about a decade ago. So I think China for us is not that big of a factor. We've not always looked at China as being competition or a market that we would want to be in. But China has been leading a lot of growth in investments in the mining industry. So they do own a lot of resources and assets globally. And one cannot ignore them, but we would find a way of how we can still coexist with Chinese vendors.
Okay. So you had a fairly decent Q1, and I'm using that as a cue to just try and understand what you likely think of how growth can be over the course of the next, let's say, 3 years, or I don't know if it is possible to think of 5 years in such a volatile world. But I'm guessing while you talk about quarters at the end of every quarter, what is the larger vision, let's say 3-year, 5-year game plan, if you will?
So if you look at our past 7-year history, we've been growing at a CAGR of about 20-odd%. Right? And over the last 3 years, we've been guiding the market at about 15% CAGR. Of course, in the last 7 years, our base has moved up as well.
Yes.
So today we're roughly at about 1,500 crores at FY24 revenue numbers. And the intention is to continuously bring to the market new products that can help us leverage our operating capacity and at the same time maintain our margins. So the trick is how do we continue to grow at 15% and above and still maintain our healthy 21-22% EBITDA that we've been demonstrating so far. But I firmly believe that we do have the product lines, we do have the strategy in place. McNally is an equipment business that we bought to ensure that the growth momentum is sustainable, and we're quite confident that it will do so over time.
I want to talk about your product because I think a product mix or launching new products, discovering new geographies is probably where your next leg of growth will come from. One product that I read about and heard your interview across was Dino Prime. Give me a sense of what is the sort of growth you're expecting for Dino Prime over the next 2 to 3 years. What is the contribution of Dino Prime currently to your books? I'm assuming, again, low base, potential to grow is higher. Could this sort of help you scale and beat that 15-17% growth that you're aiming for?
So Dino Prime is a homegrown product line. We launched it in the market in 2018, and the intention of launching Dino Prime was to offer customers an option of using an alternate lining substrate other than steel liners. So in the grinding mill business, steel liners have been pretty much dominant over the past many decades for the lack of a better alternative. And in Tega, we were able to develop a product in-house from our own product stables that we could bring to the market with reasonable amount of credibility now and a huge reference base, which gives customers the confidence that there is a product that's available as a substitute. And the idea is to continue to push through with Dino Prime in the steel lining segments. So for example, we estimate the steel line market to be about $900 million. And we're just barely ex-China.
What's your market share in that $900 million?
We're just about scratching the surface. I think we're about anywhere between 3 or 4% as of now. So there's a huge upside and headroom for us to grow.
So in 3 to 4 years from now, where do you see that market share stand at? And what are margins here? Do you enjoy better margins because it's an in-house product?
So margins are similar as our existing product profile, but right now we're still in the seeding phase, right? We're still in establishing the product in the market. There's enough traction, but the idea is to get all the trials done first and then be able to improve on the pricing. So once the customers have experienced the product, have benefited from all the KPIs that we've been talking to them about, and assuring them of, then there's an opportunity to put the price up and have better margins from that product vis-a-vis other product lines. But Dino Prime is a product that we think is a product of the future. It is something that I think customers are going to greatly benefit from and is going to be a pretty new innovation in the market. where we are cannibalizing the steel liners.
Okay. And what happens, I mean, in order to get this growth numbers that you've spoken about, we've not even reached the inorganic side, but do you need to expand the product portfolio meaningfully, or with the current set of products, Dino Prime and others, you reckon that this growth number is eminently possible?
So at any given time, we have over 8 to 10 products which are in our R&D stables. So we have a big push towards the digital space of using IoT sensors in our product, because I get more and more customers telling me that I need to de-risk my operation. And one of the ways to do that is to be able to have advanced warning systems, which tell them that it's an engineered product, right? So it has its own inherent issues of maybe there could be an issue with the product or with the plant. And how do we ensure that the customer knows about it in advance and can plan for it? So you have sensors in it which talks to the customer and can forewarn them if something is not right. So that's a big digital push that we're working on. Again, because I said it's a critical equipment that we supply our product to. And these are the initiatives that we're working on, which will ensure that our growth rates and margins remain sustainable as we continue to forge ahead.
So you have two sort of streams. You've got mill and non-mill.
Yeah.
Everything we've talked about on the product side falls under the mill category. Yeah. And how are blended margins there, right? So and where do you see that split at? So where is mill versus non-mill right now? Where do you want to be in 2 to 3 years, and what will that do for your margins?
So mill is about 75% of our
And it's
total.
a better margin business?
They're comparable. I think non-mill is slightly better in terms of margins.
Okay.
Mill is higher volume, and in absolute terms, mill would be a higher margin business. But in percentage terms, I think non-mill is slightly better, a few 100 basis points better.
And you want to improve that product mix?
So mill today is at 75% of our revenue. Ideally, I would like to see it at 60% of my revenue.
Why is that? If these are sticky clients, you're inventing products, you're working with new offerings, and why increase the contribution from non-mill? I mean, what is it going to do for you?
Because of better margins.
So there are better margins. Yeah. Also, one quick question with this whole wave of renewable energy, I think most of us even discussing it know only little, right? The use of lithium for batteries. Tell me whether is it a plug and play model? Do you have the technology to go out there and, extract lithium? Would you be investing in that technology and hence looking at inorganic expansions? Because if that is the future, you want to have the first mover advantage of sorts.
Absolutely. So lithium today is still a new discovery in terms of a metal group. People are still figuring out ways of how to extract it in the most efficient fashion. So there are different technologies right now that people are working with, but not one single one that's become dominant as of today. But with our McNally acquisition, we do have all the equipment that's required in a process plant to extract metals, as I mentioned. So in lithium, there will be different alternate strategies available depending on how the lithium occurs in the ore body. So different metal groups behave differently in different ore bodies. So that will determine how they extract that. And we do have the equipment for conventional mining as of today. But it may require some further investment, but we do have the baseline technology to improve on it as and when that comes up.
Interesting. So I get back to the same thing, but I'm just trying to probe this a little bit more. So if with all the expertise that you have and the leadership in certain categories that you might be having and the balance sheet that you're sitting on, you're guiding to a 15% growth for a company which is arguably in its growth stage. So does the kicker in growth above this come via product expansion, or does it come via inorganic opportunities? Because your balance sheet leaves you primed for making inorganic moves if you want to.
Find me a deal.
No, but I'm just trying to understand. Are you on the lookout? Yeah.
So we're always on the lookout. So we're a company which is continuously hungry, perpetually hungry for growth. And we always constantly look and evaluate deals on a constant basis. But as and when we do find an opportunity, we are not going to shy away from it. So we do know that we have balance sheet leverage. We have the ability to consume larger transactions. But other than just the inorganic play, which I would for now leave outside of the 15%, I think we still have a very good evolving story in the equipment business. And I think over and above what we're doing organically, the McNally play was something that's going to be the biggest kicker for us in the next 5 years, I would say.
Have you managed to clean up the McNally acquisition, and is it now become a significant growth driver for Tega that you're aspiring to, or was that still a few quarters out?
Well, it's just been about 14 months now since we acquired the business. There's still a lot of work to be done.
So how much alpha do you think could come in from that over the next maybe 1-2 years, or even a few quarters
Just to give you some perspective, we were at about 160 odd crores in FY23 when we bought the business in McNally with a 5% EBITDA. We closed at 200 crores in FY24 with a 10% EBITDA. And the idea is to continue to push the EBITDA margins up 100 to 200 basis points in the current year, if and when that does happen. And from here on, with a low base, given the opportunity presenting itself in the country, I think we're going to grow exponentially in the top line for the equipment business going forward.
Correct me if I'm wrong, but NMDC was a deal that happened largely on back of this acquisition? And so, you want to walk us through that and tell us whether, because India is such a small market for you right now, is there a potential for growth here? Because it's only a matter of time, you'd imagine.
Yeah, so NMDC we won on the back of a consortium with another partner called Kalpataru Projects. And the reason for bidding jointly for that was that the piece was too large for us from an entire project execution perspective. So we didn't want to get involved more on the civil side, but our forte is the equipment piece.
Yeah.
So it was a win-win for Kalpataru and us that we were able to solve for it in a way that we brought in the equipment and the plant process technology, and Kalpataru brought in the civil expertise. This is a strategy that is different from what McNally has been doing in the past. And this is our way of demonstrating that we are thinking out of the box. We are thinking of India from a different perspective. India is poised for a huge growth in the infra side of things. And we want to ensure that we are a part of it, the growth story. And this is a way of how we want to solve for it.
Similar conversations underway with other players such as NMDC?
Constantly.
Anything that we can expect in the next quarter?
Well, we constantly try and make such transactions happen. These tenders, as you know, do take its time. And as we try and work through them, hopefully, I think there should be a few more to come.
What's your success run rate in these tenders that you bid for?
Well, so far it's 100%. We bid for one and we got it.
What are you bidding for right now then?